G'day everyone, welcome back to Pete's Investing. Today we're looking at the alligator strategy, which we've already covered in some previous videos, but today I'm going to be looking at percentage gains and percentage of averaging down approach in terms of when to trade and sell out. So don't forget as always to hit the subscribe button, the notification bell and the like button, and also review our indexes playlists, the share price review playlist and the strategy playlists. And in the strategy playlist we look at the simple trading strategy, the average down approach, and some CCI approaches and some money management ideas. This is not financial advice, it's purely just an educational video series to improve your share trading. So let's get started. First of all, I want to show you the summary of results, and what I've done here, I've picked a consistent number of shares we've been tracking since the start of 2021. Some from Australia, a couple of shares from Australia, Europe and the US. Now what these results have shown, this is the logic, and I'll go back to the chart on this and explain a bit more detail. And this result here is the profitability over that time period since the start of 2007. And based on today's date, that equates to about 179 months. This shows the number of contracts entered, and if we're trading $2,000 lots every time we buy, that equates to the total number of contracts at the worst case when it's averaged down that many contracts. And this shows the maximum drawdown. So I'll explain what each of these things mean in the chart. So let's look at the CBA for a starting point. So if you look at the CBA here, you can see here we started back in 2007 for all these trades. And the reason for that is we want to take in consideration the GFC during 2008, the impact that had. The price you can see here appreciated, and then also the effects of COVID at the start of 2020 and what that's happened since then. This top chart shows the profitability of the trades, and these steps indicate how many times we've entered the trade. So in this case, that little would have been an enter a trade, enter some shares there, buy some shares there, and exit where the steps down, that's exiting the trade there. Bought another lot of shares there and exited there, then bought another lot there. Because the price then declined, we averaged down at that point, bought more shares there. So now we've got two sets of, so each of those have been $2,000 lots. Here was the first $2,000 lot in this particular trade. We averaged down, so now I've got another $2,000. So that plus that is $4,000 in this particular trade in that period. The price then went sideways for a while, then it declined. We added another lot of $2,000 lots. So here we've got $2,000 for $6,000 of entries made at that point, and that shows you the decline in profitability, and that would have been the biggest drawdown. So that drawdown I mentioned earlier, this drawdown, 8,500, equates to that period there, from that high there. So let me just expand that. You can see there the profitability went from that point there down to that point there. So if I draw a quick measure tool from that high down to there, that's 2474. That's the profitability that would have been drawn down. So again, that's the profitability chart, and this is the number of shares entered. So here we've entered individual single lots of shares. So $2,000 lots there, entered and exited, made a little profit, entered and exit, and so on. We entered another multiple average down at that point there because the price went against us. Another multiple average down there as well. I won't go through all these companies, the charts, so for the sake of time. That's pretty much it for the CBA in that particular example. So what we're looking at here is 3193. So 3193 in terms of profitability. We entered 3 contracts as a maximum. So you can count that as 1, 2, 3 in that particular spot, or 1, 2, 3 there, or 1, 2, 3 there. So the most it entered was 3 contracts. That equates to that. So if we're trading $2,000 lots, 3 times 2,000 is $6,000. And the maximum drawdown at any particular point, we simply look at the highest point of profitability to the lowest is 2508. That's the maximum drawdown recorded. So that's what we record there, 2508. So what we do basically is look at that $6,000, which is the number of contracts, plus the maximum drawdown. So we're down 8,500 at the worst case during that period since 2007. So it doesn't mean we're consistently down, it just means that down at that particular point. And this profit over drawdown percentage is simply the profit divided by the drawdown, which is 8,500, which is 38%. So we did that for each of these. Now let's look at the logic. We enter using the alligator strategy. So this is the Williams Alligator strategy. We enter when the alligator teeth is greater than the jaw. So the teeth is a red line and the jaw is a blue line. So let's drill down and look at an example. So if you look at it here, the alligator teeth is the red line and the alligator jaw is the blue line. So when the alligator teeth crosses above the jaw, that's when we enter the trade. And I've drawn a little indicator here. So it puts an indicator up there. When that breaks above, the red line breaks above the blue line, that's indicated by that. And then it closes out when the red line crosses down from the blue line. Now our strategy is to buy when that crossover happens there, we buy. And we exit when the close of the bars breaks down below the red line. So that's our exit. We close when the blue line. We close when close below the blue line. So when it crosses down below the blue line. And I've drawn another little indicator which indicates that in case it's hard to read, but that's pretty obvious to read in this example. And lastly, and also we look at the exit of the close. We want to have a minimum gain of 3%. So the minimum gain looks at, we want to make sure that the minimum gain, so look at the draw point there. So if we entered the trade point there, and we exit there, you can see there we gained 13% in this particular trade. So what we're basically saying is 3% is down there somewhere. So we're saying anything above that, had that turned the red line, the close breaking below the blue line anywhere in that period, we would have closed out the trade. That's our exit. So in this case, it closed out 13% above our entry, which is well above our 3%. So it closed out there. Next, we look at the average down approach. So we're looking at the average down. Let's go back to our example, a chart. Let's pick an example like in this case here. So we bought one lot of shares there. Let's just expand that. So we bought one lot of shares there. The price went sideways. Nothing really much happened. It appreciated a bit. You can see there the profitability went up slightly, but then it dived during COVID. Okay, so in March 2020, the price dropped. So then we entered another lot of shares there. That reduced our average price down to around this area. Not indicated on this chart, but simply look at the entry, which is that point there, and our second entry was that point. So we entered two lots of $2,000. So the average price would have been somewhere down here somewhere. So we're saying when it closes less than the average price, which it was on that second lot of trade, and this is basically the same as the entry criteria, when the red line crosses above the blue line. So again, you can see there, and again indicated by this little indicator there, the red line breaks above the blue line, so we enter our second lot of shares. And that's also the other criteria is it has to drop at least 5%. So again, looking at from the average of that entry there, we entered it down here somewhere, down there, second lot. It dropped by 23%. So basically, we're saying 5%. So anything about there, let's call it that, anything below there, we could have entered. So had it turned up, had the red line broken above the blue line, anything below that, we would have entered. In this case, that was COVID. It dropped pretty significantly. We entered our next lot of shares there. That's our average down approach. And then lastly, closed out. Again, looking at exit strategy. The close broke below the blue line, and we gained a 3% minimum gain. So again, the close broke below the blue line there, and that was also based on our average price, and if the average price was there, that would have been greater than 3%, so we closed out. So in summary, if you look at that trade there, the profitability there was, our baseline is 100,000, but say the profitability there was 26.25. And the profitability there started as 25.30. So I gained about $100 and something on that trade in those few months. That's our strategy. So over the whole total period, that's what it gained for Commonwealth Bank. BHP did similarly. You can see there the profitability over drawdown results. Now, I'll just show you a couple of quick ones here. The best gainer here was Johnson & Johnson. So if we'll draw down on Johnson & Johnson, you can see here most of the activity happened of averaging down back here, but the rest of the price chart was going fairly consistently upwards throughout the whole period. Hence, they've been doing quite well in terms of profitability. The worst performer on this particular table is Telefonica from Europe. So if you look at Telefonica, why is that performing poorly? So you can see here, it was doing not too bad during the mid 2020s, or 20 up to about 2017, but then it started declining from there down. So that's why we're down in profitability, because it's been averaging down and hasn't closed out. Now when it closes out eventually, that will go above the profitability of there. So that's the purpose of the average down. It's designed to break above the profitability of where you started from. Okay, so that's pretty much why that is is a very low performer. It's only scoring 4% of profit over drawdown, only because it's pretty much, I would say, midway through its averaging down so far. So again, once that breaks above the average down break point and it breaks above 3%, it'll break profitability above 23.89. We're currently sitting at 452, so it's got about another just under $2,000 to gain, but that if the price appreciates, it should go up there pretty quickly. That's the average down approach using the Alligator strategy. And again, just very quickly, the Alligator strategy has 3 lines where we focus on the red and the blue line, and that's why we trade using that logic there. So feel free to freeze the video, digest that logic, and apply the percentage gains and downturns to exit and average down on your approach. Be careful of applying too high a percentage of a gain and too high a percentage of a downturn. Let me quickly demonstrate what would happen. Let me go quickly back to a good performer. Let's pick Johnson & Johnson again. So if you look up here very quickly, that's been doing quite well. There's a lot of single trades, there's one double up there and a double up there. Let's change the percentage gain from 3%. Let's make it 10%. Okay, we're going to be adventurous and go for a 10% gain. Let's see what happens now. So first of all, a couple of things to look out for. The profitability is currently 36.05, and just look at these steps and see what if anything happens there. Now you'll notice that extended the average down because it needed to get to a higher percentage gain, and the total profit went up 44 to 21. So if we make that 20%, so that's closing out now on the early, about April 2011. All right, so if we make that back, put that back to 3%, you can see there it closed out quicker. Closed out in 2009 instead of that point. So you can see how it's reached that 3% gain versus the 10% gain a lot quicker. So be careful of putting in too high a gain on your profitability gain. Likewise, percentage down is 5%, so let's make that 20%. That's a negative 20, by the way. Let's see what happens now from 36.05. So the amount of trades open, so it's lost about $200 there. So it hasn't done too badly. But again, just be careful. You got to play with the percentage gains and losses to get a nice balance. So we'll leave it at 10% drop and a 3% gain before we can get too excited about getting. Basically, if you want to get out early, just try to reduce your profitability to get out quicker. Otherwise, you might be locked into especially if the price goes sideways. Let's pick another stock as an example. Let's pick BHP. All right, that's had a more volatile result. So 40.84, you can just have a quick summary of that. That's opened there and it closed out there at February 2018. So let's change that logic again. Let's make it what do we say before? A 10% gain and make it a 20% drop. See, they'd extended it out by a few extra months and the profitability was up slightly. So again, just be careful and just be mindful of how much you put in terms of a gain and a loss. Okay, we'll keep reviewing these, and I'll try and experiment with some other strategies using some other indicators. But at the moment, we've found the alligator strategy with these percentage gains and average downs works the most effectively in terms of returns. Don't forget to hit the subscribe button, the notification bell, and like the video, and we'll speak to you soon. Thank you.